So just briefly, can you tell us what have you been speaking on here today?
Yeah, we were talking about emerging markets over the sessions, emerging market fixed income, particularly on the tough year that the asset class had last year in 2013, what has been repriced, what are the opportunities and challenging, but most importantly, what is the right strategy to go forward, how investors have been reassessing the way they look into emerging market debt. There has not been a capitulation despite the volatility, but what indeed has happened is that investors is really thinking what is the best approach to invest in emerging debt going forward. So we discussed the approach, what we think is the best strategy, but also why flexibility, an unconstrained approach and active management is now even more relevant than it used to be in the past. Not surprisingly, I believe that the delegates have perceived the focus of the seminar as very timely, because they share our concerns. So the views that where we see the asset class that is moving at different speeds, where we see that the rotation between hard currency debt to local debt is happening pretty much as we speak, and the same concerns that the delegates are seeing regarding valuations, if volatility is going to continue, and what is the right way to play this volatility or to deal with this volatility. So I think the perception has been very positive. We are not telling clients that what happened in the past will continue to work in the future. We're, if anything, telling them there is a new regime, there is a new era for emerging market investments, and I think that we gave a lot of food for thought on what is the right approach for them going forward. The questions have been actually very diverse, and I think it was quite interactive, but most of the questions were towards our approach, because for this new era of investments, the main concern is how to anticipate drivers or scenarios that can impact emerging market bonds, and how we manage to extract alpha by being thematic. Our approach to emerging markets is quite unique and quite specific, and most of the interest was exactly in how we translate our scenarios and our thematic strategies into positions, into a portfolio and alpha trades. We enter this year in a much stronger position than before the sell-off in May 13, and if anything, the performance of the first quarter of the year in emerging markets has been very strong, but we advise caution to investors, because the reality is that we are in an environment of high volatility, rates going higher, fundamental dispersion. So of course that although we are much more constructive, we remain cautious, and we think that the right approach is one with a lot of flexibility. Opportunities are there, but risks as well. We're going to see much more dispersion in the returns within each segment, but also dispersion between the countries, the currencies. So it's very important to try to be very nimble in how to trade emerging market debt going forward. We think that being active and very flexible is going to be very important to capture those opportunities. But the case for beta is not as strong as it used to be 3 years ago. We think that now we are in an environment where most of the returns are going to come moderately from beta, but a lot of that from alpha as well.